We're going to start this lecture talking about depreciation for federal income taxes. When a business does its income taxes for the year, they've got to report what kind of depreciation they have. And no matter what method they've used in their business, straight line, double declining balance, whatever, they have this MACRS code. You'll see Modified Accelerated Cost Recovery System, commonly referred to as MACRS. It's an IRS code that is used by businesses to report their depreciation. So you see there are 8 classes of useful life and depreciation rates. The 2 most common classes are 5-year and 7-year, and there are other 3-year, 10-year, but 2 most common are 5 and 7 years, and it gives an example there of what types of assets fall under those specific categories. And then you'll see for the 5-year class assets, depreciation is actually spread over 6 years. And they give you the percent. This is just given in the federal income tax code with the MACRS depreciation. They'll tell you each year what the depreciation is, and you'll see the 5-year class assets have actually depreciation over 6 years, and it'll add up to 100%, and it'll depreciate it all down to 0. We have looked at depreciation where there's a residual value. With MACRS, there is no residual value. Sometimes you have to revise your depreciation estimates. So we have an example here. A machine purchased on January 1st for $140,000 was originally estimated to have a useful life of 5 years and a residual value of $10,000. The asset has been depreciated for 2 years using the straight line method. So we got to figure out where we are right now. So we have the $140,000 purchase price minus the residual value of $10,000 will give us our depreciable cost, which would be $130,000, and we're going to depreciate that over 5 years. When we take a look at that formula, we'll see that it's $26,000 per year. So we have been depreciating for 2 years, so it would be $52,000 already depreciated from the asset. So at the end of 2011, the asset's book value was $88,000. So it'll tell you the asset cost of $140,000 minus the 2 years depreciation. The value of that asset on our books, it says that it's worth $88,000. During 2012, the company estimates that the remaining useful life is 8 years instead of 3. So we're going to get more use out of our machine than we thought we would. And now the residual value is going to be $8,000 instead of $10,000. So we're adding on an extra 5 years of life, but it's going to be worth $2,000 less at the end of that time. So depreciation for the remaining years are going to be determined as follows. The book value at the end of the second year is $88,000. So that's really going to be what our starting value is now. We've depreciated it for 2 years using the old method. Now we're going to start. Now it's worth $88,000. And we say it's going to be have a residual value of $80,000. So now over this new useful life of 8 years, we have to depreciate $80,000. So our $80,000 divided by our 8 years, we now have an annual depreciation of $10,000. Since the life has been extended, it's like we go back to point 0 with whatever the value was that we had calculated through depreciation already. So you can see a graph here of how that would look. Our asset was $140,000. We did the $26,000 each year. And then when we had the change in the estimate, you'll notice our line becomes less steep because we're depreciating less and less each year. And the y-intercept here is going to be at the $8,000 instead of the $10,000 it would have been at had we not changed our estimate. And it would be at a sooner year because we only have 3 years left on it. Now we've extended it out 8 years. So let's take a look at an example for a revision of depreciation. A warehouse with a cost of $500,000 has an estimated residual value of $120,000. So when you think about our depreciable value, it's the difference between those two numbers. It has an estimated useful life of 40 years, and we're using the straight line method. So you have to first figure out how much annual depreciation, then the book value after the 20th year of use, so halfway through the use of it, and then if at the start of the 21st year it is estimated that the remaining life is 25 years, so we've added an additional 5 years on our life, that the residual value changes to 150, you're going to determine depreciation expense for each of the remaining 25 years. Take a moment and calculate this. If you need to look back at the previous slides and the example of re-evaluating the estimates, do that. Remember, first find how much it depreciates, multiply that depreciation by the 20 years we've already done. Then we have a new book value. Use that new book value to answer C. Pause and calculate. Hopefully this is what you've got. Our $500,000 minus our $120,000 is our depreciable value divided by the 40 years means $9,500 per year. For letter B, we've depreciated $9,500 per year for 20 years. And when we subtract that from the original value of $500,000, we have an ending value of $310. This is the current book value of our asset. For letter C, we have to go ahead and reevaluate the whole thing. We pretend as though the $310 is our starting value, and we have a new residual value of $150,000. So we take that $310, what it's worth on the book value. We have $150,000 that we're going to have as our residual value. The difference divided by our new life of 25 years gives us a new depreciation, annual depreciation of $6,400. Our third goal is to journalize entries for the disposal of fixed assets. So assets we've had over a long time, we're finally going to get rid of them. They've reached the end of their useful life. We have no more use for them. So for discarding fixed asset, we have a piece of equipment acquired at a cost of $25,000 and it's fully depreciated at December 31st. If on February 14th, 2010, the equipment is discarded, what we do is we debit our accumulated depreciation. That way we get rid of that depreciation. Once we get rid of the asset, we get rid of the depreciation as well. When we get rid of the equipment, we're going to credit that asset so that there's a zero balance in our equipment account and a zero balance in accumulated depreciation. We no longer have that asset or anything tied to it. We have another example, equipment costing $6,000 with no residual value, meaning it's going to be worthless when we're done with it, is depreciated at an annual straight line rate of 10%. After December 31st, 2009, adjusting entry, accumulated depreciation equipment has a $4,750 balance. On March 24th, 2010, the asset is removed from service and discarded. So you can take a look and see the explanation here. To record current depreciation on equipment discarded, it says $600 times 3/12. Because our equipment costs $6,000, it's 10% a year, which would be $600. So it's $600 per year. But we have December to March, so that's 3 months. So it's only going to be $600 for those 3 months, January, February, and March. So the depreciation that's left is only $150. So we put the depreciation into our accumulated depreciation and we write that off as an expense. So $600 times 3/12, again, January, February, March, is going to give us that partial year depreciation. The discarding of the equipment is then recorded, so we have a second part of our entry. So first we updated our depreciation, updating our depreciation for those 3 months, and then now on March we're going to get rid of it. So this is the second entry on March 24th. We have accumulated depreciation of $4,900. The $4,900 comes from our balance of $4,750 in accumulated depreciation plus our partial depreciation for the year. That's $4,900. So we're going to write off the depreciation for $4,900. We also need to get rid of the equipment. The equipment was $6,000 and no residual value. So the balance, the equipment had a value of $6,000 for that asset. We need to get rid of the $6,000. So you'll see there's a difference between the depreciation of $4,900 and the value of $6,000. So since there's that difference, we have a loss on the disposal. We disposed of it and we only depreciated $4,900 worth of it. We did not get that full $6,000 value of it. So we discarded it maybe earlier than we thought we were going to, earlier in the year. So March instead of what we would have assumed as December. So we lost $1,100 of that value because we got rid of it sooner than we expected. If it was a difference and the accumulated depreciation was larger, we'd have a gain on the disposal and it would be on the credit side of the equation. So here's a selling of the fixed assets. And the other one we disposed of it, we just got rid of it and we wrote it off as a loss. For this one we're actually selling it. So equipment was purchased at a cost of $10,000 with no estimated residual value, 10% depreciation per year. The equipment is sold for cash on October 12th of the 8th year of its use. So you have to figure 10% of $10,000, go ahead and calculate that. Or if you can do it in your head, that's $1,000 per year. So after 8 years, well, it wasn't 8 full years because it's October 12th of the 8 years. So it's 7 full years, which would be $7,000, plus we have 10 months of the next year. So we have to do 10/12ths of that, or 5/6 if you want to reduce the fraction. So we have the entry here. You'll see the equipment is sold, or 3/4 times 10% of the 10,000, because it's only 3/4 of the year, because it's in the beginning of October. So our depreciation expense on the equipment is $750, and our accumulated depreciation is $750 to update the depreciation. So that's our first entry, whether we're selling or disposing it. Figuring out we had the 9 months here of use, because this is before the 15th, we would consider it 9 months. We have to update that accumulated depreciation. So there's our update. Then we go ahead and sell it. The equipment is sold for $2,250, no gain or loss. So what we have here is our cash of $2,250. We have to get rid of the whole value of the equipment because the equipment is gone. And in this case, we just have the rest for accumulated depreciation, because that is the depreciation that was in our account, the balance of our accumulated depreciation account, which you can see it was $7,000 as of December 31st, plus the $750 for this current year. We take it out of accumulated depreciation because we were on track, so we sold it for no gain or no loss. The equipment is sold on October 12th for $1,000, a loss of $1,250. So if this is the case and we sell it for $1,000 instead of the $2,250, we again take the $1,000 for cash, and the $10,000 has to come out of equipment. The accumulated depreciation is still the $7,000 for the first 7 years, and the adjustment of $750 for the next year. So you'll see debits have to equal credits. We'll see we have a loss here that's going to debit that loss for the difference between the two. We have assumption 3 with a gain. We sold it for $2,800. Again, cash is just whatever you collected. Your equipment is going to be the value to get that entire value out of there. Our accumulated depreciation was what we calculated for that 7 years and then through October. And then to debits equal credits, we need an extra credit. We actually gain on that sale of the asset $550. So here's another practice problem. We have equipment was acquired at the beginning of the year at a cost of $91,000. Straight line method depreciation, useful life of 9 years, and a residual value of $10,000. Pause and see if you can calculate A, B, and C. Depreciation for the first year is based on the straight line method. We have an assumption of a sale, and you have to decide whether there's a gain or loss, and you're going to journalize that. Pause and attempt this problem. So taking a look at the answer, the first one, $9,000, we have the $91,000 cost minus the $10,000 residual value depreciated over 9 years. That's review. Then, hopefully for B, you got a $5,000 gain. So we had $91,000, then minus the $9,000 times 2 years. The $78,000 that we sold it for, minus that, we had a $5,000 gain. So we actually made money on this sale. The entry then, the cash is the amount of cash they gave us. We sold it for $78,000. The equipment, we've got to get rid of the total value of the equipment. 2 years of depreciation at $9,000 is $18,000. Debits have to equal credits. We have that gain of $5,000, and it showed us the gain in letter B. You might want to look back at some of the previous slides, slides 67, 66, to see how the gain and loss was calculated on those slides for extra practice. This concludes your notes.